Imagine you're given $10,000. You can put all of it into one stock, or you can split it into different things. Now, here's the crazy part. The difference between those two decisions could mean the difference between retiring at 40 or working until you're 70. And it has nothing to do with picking the best stock. It's something way simpler. It's called asset allocation. And today, I'm going to explain it like you're 12. Most people think investing success comes from finding the next Tesla, timing the market perfectly, or watching financial news all day. That's wrong. Research from firms like Vanguard has shown that most long-term portfolio returns come from asset allocation, not stock picking. In other words, it's not what you buy. It's how you divide your money. Think of your money like a pizza. You don't make a pizza with only cheese. You divide it. Some crust, some sauce, some cheese, some toppings. That division, that balance, that structure, that's asset allocation. In investing, the slices are stocks, bonds, cash, real estate, and sometimes commodities. How big each slice is determines how your financial life tastes. Here's asset allocation in one sentence. It's how you split your money across different types of investments to balance risk and reward. That's it. Not complicated, but incredibly powerful. Let's make it even simpler. Imagine 3 friends: Jake, Emily, and Sarah. Jake puts 100% of his money in stocks. When the market goes up 20%, Jake celebrates. When it crashes 30%, Jake panics. Emily splits 60% in stocks and 40% in bonds. When the market crashes, she drops, but not nearly as much. Sarah keeps 100% in cash. She never crashes, but she also never really grows. Each one made a different asset allocation decision, and each one gets a different financial future. Now, here's why this matters, especially if you live in the United States, the United Kingdom, Canada, or Australia. You likely invest through a 401k or an IRA, or an ISA, or a SIP, or an RRSP or a TFSA, or superannuation. Inside those accounts, you're choosing funds. And most people don't even realize they're already making asset allocation decisions. When you choose an S&P 500 index fund, a global fund, or a bond fund, you're deciding your risk level, even if you don't know it. Here's the truth. People don't fail because markets crash. They fail because they panic. When your portfolio drops 30%, your brain screams, "Get out!" Asset allocation helps prevent that. If your portfolio only drops 12% instead of 30%, you're more likely to stay invested. And staying invested is where wealth is built. Let's simplify this to 3 basic models. First, aggressive. 80 to 100% stocks. Huge upside. Big volatility. Good for young investors with strong stomachs and long time horizons. Second, balanced. 60% stocks. 40% bonds. Moderate growth. Moderate risk. This is the classic grown-up portfolio. Third, conservative. 30 to 40% stocks. 60 to 70% bonds or cash. Slow growth. Low volatility. Good for retirement or short-term goals. There's no best one, only the one you can stick with. Here's the secret nobody talks about. The perfect allocation is the one that lets you sleep at night, not the one that looks best on paper. Because if you panic sell during a crash, even the best allocation fails. Investing is more psychological than mathematical. So, how do you decide yours? Ask yourself 3 questions. When do I need this money? If it's in 1 to 3 years, you should be more conservative. If it's 20+ years away, you can afford to be more aggressive. Second question, how would I react to a 30% drop? Be honest. Third question, do I want simplicity? If yes, consider broad index funds. For most people, one total market fund and one bond fund is enough. You don't need 20 ETFs. Here's the million-dollar insight. Warren Buffett once said that asset allocation is more important than security selection. You don't need genius. You need discipline. Over 20 to 30 years. Small, consistent gains compound into life-changing wealth. But only if you stay invested. Asset allocation helps you stay invested. So here's the takeaway. Stop trying to pick the next big winner. Start designing your pizza. Because investing isn't about being flashy. It's about being consistent. And consistency is what makes people rich.